Let's get to our next guest here. Sees the market grinding higher due to peaking inflation. Julian Emanuel leads strategy for Evercore ISI. He joins us here at the NASDAQ. Julian, it's great to see you in person. It's been too long.
Who says you can't ever go home again? It is so great to be with you and Dan and the team. Thank you.
What do you think? You were nodding your head when Steve was talking about the notion that the market has done a lot of the work in terms of tightening. If Bullard had his way and we had 3.25%, by the end of the year, additional tightening, what do you think that we would do, the markets?
So first off, I think we have to understand the context of Bullard himself. He has been a hawk consistently, and I think part of his remit is to guide the rest of the Fed towards that more hawkish stance and the market itself. And by that standard, he's done an amazing job. And if you think about when those comments hit in the last 15 minutes or so of the day, what happened? Stocks loved it because they loved the fact that, as Steve pointed out, the comment is it's in the price already. The market gets it.
But is it in the economy? Then that's really I mean, I think that's one of the reasons why I think a lot of market participants are trying to figure out, what is the pace of a slowdown, because they need to slow things down. So that's, I get it. Like bond investors, they moved. And now, when is it going to hit the economy?
So if you look at it and you think about a year like 1994, which is a lot of the comparison, and actually the last year, the only year in the last 40 where both stocks and bonds were down for the whole year, as they are sitting here in mid-April, is that the market just sort of digested it, and there was a lot of sideways chop. There was a lot of bearishness. But at the end of the day, earnings carried the day. And that's what we see when we think about 22 and 23, because we don't think there's going to be a recession.
Tim's got a question.
Hey, Julian, it's Tim. Welcome back. But does the market, with a forward PE multiple that hasn't necessarily priced in policy accommodation and the tightening that I think and the extreme pace that Bullard just talked about, I mean, that's what should concern folks. It's not that the market hasn't done a lot of work already. It's not that we all don't believe the Fed needs to be aggressive. The question is, Dan referred to the economy. I'm not sure we've heard from companies in an environment where rates are 125 basis points higher, and I don't think stocks have priced that.
So I would agree with that, Tim, and I think part of what has really kept people on the back foot coming into the start of this earnings season is this idea that we're going to get negative commentary, we're going to get downward revisions. And we might. But our point of view is from a stock market perspective, with lots of delevering going on, 15% bulls, essentially a 30-year low, that's in the price. Now, as far as the economy is concerned, again, to us, it is a question of, can you manage through what's already in the price from an asset market perspective? And our view is that as difficult as the external circumstances have been abroad, and certainly slowing down in China now, the U.S. consumer is still intact.
But in terms of things being priced in this negative commentary, Julian, do you think companies will actually stick by guidance when they can easily say we've got inflationary pressures, we have question marks about markets around the world because of Ukraine, Russia, and because of what's going on in China? I mean, it feels to me that it's the perfect opportunity for companies to give negative guidance and to cause earnings estimates to come down.
So I think there has been an element of caution, but in fact, part of the story that's been remarkable is that margins on balance haven't contracted because the pricing power has been there. And again, it comes down to the consumer. Could pricing power erode? It could. But you're speculating that that's going to happen. And from that point of view, look, are you going to get peak commodity prices, peak inflation, as we think may be happening? You're not going to hear that from companies. They don't need to take that risk guidance-wise. But on the other hand, we don't think they're going to be, very, very cautionary, because they really haven't seen the evidence concretely themselves.
Julian, thank you. Good to see you.
Great
to see you again in person soon. Julian Emanuel. Guy Adami, what do you think? I feel like I know what you think. That's a terrible thing to say. But in terms of the kind of guidance we're going to hear from companies this earnings season and whether or not they continue to have pricing power. Remember, a lot of companies have already instituted a round of price hikes on consumers for various other reasons prior to this.
Yeah, you do know what I think. I think clearly margins are going to be impacted. And again, I think Tim and Dan said it as well. The bond market might have priced all this in, but I don't think the equity market has at all. You go back to March, April 2020, obviously the bond market moved extraordinarily quickly, but the stock market rallied for the next 18 months. So you could say the bond market moves quickly and the stock market sort of lags. So in that regard, I think the market has more room to downside. And then the question is, what's the right multiple in a higher interest rate environment for the S&P 500? I don't think it's 21, 22. I think it's closer to 18. You know, on $230-ish of earnings, we can start doing the math and figure out where the S&P should be.
Karen, do you think the consumer is as strong as everybody wants to give it credit for?
I mean, if you listen to Brian Moynihan today on the Bank of America call, yes, I think he was probably even characterized it as stronger than we think, you know, just talking about the average balances and very low credit and this consumer spending. And so I think that could be the upside surprise, that the consumer is very much there ready to spend.